Why are Singapore banks good and resilient dividend stocks in Singapore? Even though STI index has not been doing well for the past decades, Singapore banks are actually the outliers here. So in this video, we will go through why Singapore banks are so good and how they are outperforming the Singapore index market. Let's take an example by comparing the three banks and the STI index results. Thanks to ShareSite, I'm able to do this analysis more easily. So let's take a base case where we started investing at September of 2014 with the cost basis of around 15,000 invested. This is what we will get for the individual banks and STI index. If you have invested 15,000 into DBS in September of 2014, your total net worth will be now 33,000 with capital gains of 17,000 on top of the dividends of 10,000. This brings about a total return of 28,000. For OCBC, your net worth will be 23,000 from the 15,000 investment with capital gains of 8.3k and dividends of 7.6k. This will bring about a total return of 16,000 throughout the 10 years. For UOB, the investment from 15,000 will be worth 21,000 today, with capital gains of 6.2k and dividends of 8k. This brings about a total return of 14k. Whereas for STI index, 15,000 invested will only be worth $16,000 today. That is a pathetic return of 1.1k. So, what can we conclude from this? With the 10 years periods, these are the total returns on both capital gains and dividends. DBS is the highest at 189%, OCBC at 106%, while UOB is at 95%. STI index, of course, is the worst at just 8%. If we compare the return per annum, this DBS is at an impressive 18.51 return per annum, while OCBC is at 10.57, UOB at 9.46, and the STI index at 0.8%. I feel that this is quite impressive returns from the three banks, especially DBS, if we compare to the S&P 500 benchmark, which is giving at 21.97% per annual return. Moreover, I feel that having a 10% per annual return over a 10-year horizon is actually a very good fit. If you're interested in using this website, you can sign up for free or buy annual plans with 4 months free when you use my link below. So now, let us look at the fundamentals of why Singapore banks are so good. There are a few key parameters that we can look at for good banks. So the first parameter is the bank income. Bank income essentially comes from two parts. One is the interest income and two is the non-interest income. Interest income is dependent on the earnings from the interest of loans. This is very dependable on interest rate. Whereas non-interest incomes are other factors such as card fees and wealth management. Out of the three banks, DBS has the highest non-interest income percentage and has the highest net interest margin. This is why they are one of the better performing banks. It's important to take note that banks do not totally depend on interest rate for their income because there are few factors that will help them to control their net interest margin. With the interest rate coming down, you can expect the following from the banks. The first thing banks will do is to cut interest rate on the savings account, and this will help to neutralize some of the amount lost due to interest rate drop. Next, with lower interest rate, it's more attractive for individual or businesses to take on loans, and with more loans, it will help to offset the losses as well. Lastly, with the recent expansion in the Asian market, all three Singapore banks' non-interest income should continue to grow. Moreover, with Singapore being such an attractive and stable place, more and more people will put money with the three banks, which also increases the non-interest income. With interest rate coming down, the safe yield from different assets will drop. For those with ideal cash that wants a higher yield, Momo Cash Plus is definitely a place you can consider putting your money in. This also supports my channel by using my link. It guarantees up to 6.8% yield for the first 30 days. That is higher than some of the dividend equity in Singapore and not bad for a short-term return. These funds can also be redeemed with no lock-in periods. Existing users will also get to enjoy the promo by putting in fresh funds of at least $10,000 and maintaining it for at least 60 days. For new users to Moomoo, there is also a starter promo kit for you. By depositing $100 and making just one buy trade, you will get $20 cash coupon. Similarly, if you deposit $3,000 with 3 trades, you will get stock bundles worth $70 with fractional shares from stocks such as Apple, Nvidia, Tesla, AMD or Microsoft. Making $10,000 deposit with 8 trades will get you $210. So let's start your investment journey with Moomoo and sign up with my link today. The next key parameters for banks is ROE, which is the return of equity. Return of equity is a measure of the company's financial performance. It's a very important parameter for banks, and the benchmark is usually in the range of 10%. However, all 3 banks are performing well, with DBS highest at 18.2%, while OCBC and UOB is in the range of 14%. Even though OCBC and UOB is lower, it's still quite impressive for these 3 banks because they are above the average of the ROE for banks. The next parameter is NPL, which is the non-performing loans. Non-performing loans are bad loans which banks might not be able to receive back. Non-performing loans in the United States banks is around 1.4%. All 3 Singapore banks have minimal amount at just 1% range, which shows how good the 3 banks are in managing their loans. The fourth important parameter is the CET1 ratio. This ratio measures the bank's capital against its asset. The higher it is, the better, because this shows how much liquidity assets the bank has. Banks are required to meet international standards of at least 4.5% to ensure that they have liquidity assets available in case of black swan events. All 3 banks are amazing with CET1 ratio way above the required standard. This shows how capitalized the 3 banks are. To show how good Singapore banks are doing, Singapore banks are in the range of 13 to 15%, which are comparable to the large bank in the United States such as JP Morgan Chase and Goldman Sachs. The next key parameter, which I feel that all dividend investors will take note of, is the dividend yield. Dividend yield is essentially the dividends paid to shareholders in terms of return per year. People investing in banks mostly have one common reason, and that is to have a stable and reliable dividend stock. All 3 banks are still giving attractive dividend yields in the range of 5 to 6% as compared to US banks such as JP Morgan Chase, which currently only gives 2.2% of dividend yield, and you have to include the 30% dividend tax you have if you hold US stocks. The reason why DBS has a higher dividend yield for my calculation is because I'm assuming a special dividend yield at Q4 of this year. Why? If you read their earnings call, they have given hints which you can find in my previous analysis video. Moreover, only 50% of their income was paid as dividend throughout these years, which means that the other 50% of their income can be used as buffer for growth or can use it for increasing their dividends. The last parameter that I want to look at is the cost to income ratio. This ratio shows how efficient the company is running at. Higher ratio value would mean that it's more expensive to run the company. For bank standard, it's usually in the 50 to 60% range. However, if we see the 3 banks in Singapore, they are well below the range, and that is very good. UOB is the highest out of the 3 with cost to income ratio of 41.8%, while DBS is at 40%. Moreover, their cost to income ratio increased due to the acquisition of Citi assets recently for growth. It would have been much lower without this asset acquisition. Therefore, there are actually a lot of factors that will determine a bank's performance rather than just interest rate alone. Even in lower interest rate environment, good banks will still grow in the long term, as you can see from this prime example. Thank you so much for watching. I hope you find this video informative. Please support the channel by hitting the like, subscribe, and comment on your thoughts on banks as dividend stocks. If you want the latest result analysis on the banks, you can watch them here. Thank you, and I'll see you in the next video.